traders, Gavin McMaster here from Options Trading IQ. Just doing a quick video for you today on how to delta hedge an options portfolio. Just before we start, a quick reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. Okay, so let's say we've got this portfolio of option trades here. We've got a fair bit of positive delta in a lot of these positions. We've got one position with negative delta. Overall, we're looking at a delta dollars of 8,455. The delta dollars is a metric available in Interactive Brokers Risk Navigator. I'm not aware of any other platform that will give you this number. It's basically your notional delta, your exposure level. It's not your max risk, it's just kind of your directional exposure to the market. This is saying it's roughly equivalent to having about $8,400 invested in the market. So we use this figure rather than this figure. And delta dollars is basically just our position delta here times the stock price. And then when we sum them all up, we get an overall delta dollars of 8,455. So if we wanted to neutralize that delta, this is a good tactic when, say, the market's dropping really quickly and you don't have time to adjust all these positions or close these out, and you want to just kind of neutralize your portfolio while the market's kind of crashing. So it's a good one to just keep in your back pocket for those days when the market's really tumbling pretty hard and you just need to cut your exposure really quickly. So if we take this delta dollars figure and divide it by the S&P 500 price, let's say that's around 500 at the moment, that gives us about 16 or 17, okay? So this number here divided by 500, which is the S&P 500 price, gives us about 17. So what we're going to do is we're going to add, just off on the other screen here, we're going to add a 17 delta put option for the May expiration. There's a 17 delta put option. And if we just buy one of those put options, bang, look at that. Now our delta dollars has been pretty much neutralized. Now, the other thing you may want to consider doing is adding a beta weighting to your delta dollars number. So let's just turn this one back off again. For example, Tesla is a high beta stock. PLTR is a high beta stock. So it's typically going to move more than the S&P 500. So if we go metrics, beta risk, beta delta dollars, this is going to give us a bit more of an accurate representation of our true market exposure or our true market delta dollars. You can see here the Tesla beta delta dollars is almost double because Tesla has a really high beta. Same with PLTR, right? So now we might want to use this number as our hedge number, which luckily that's roughly double that. So in this case, we could probably do 2 contracts of that put option. And it's going to actually get our beta delta dollars closer to 0. We've got negative overall delta dollars, but our beta weighted delta dollars is closer to 0. We could change that slightly and go with like maybe a 15 delta or something like that. Might be more closer to 0. So little quick tip for you there in terms of just quickly delta hedging a market portfolio of options when the market's dropping pretty severely and you don't have time to adjust or close your open positions. Just kind of quickly neutralize your exposure by picking up some cheap out of the money puts. And again, just figure out what your delta exposure is to get you more or less to delta 0 here on your beta delta dollars. Hope that helps you. If you've got any questions, just let me know.